The first lesson that we're going to go over is identifying the dominant trend. Now, why this is so important is because it helps me identify what type of trading I want to be doing in the current market environment. This is kind of like a see the forest through the trees type of exercise, and one that I do in depth every weekend. Now, I do keep updated throughout the week. My in-depth work is done on the weekends because I want to see what transpired the week before and what I might be able to glean for the upcoming week. Recognizing the trend, the current trend, and the dominant trend helps me to determine what type of trading I want to be doing. Whether it's going to be short-term day trading, looking at potentially starting some swings, or looking at taking some long-term investments. On the flip side, it could also let me know if I want to start selling some of my long-term investments and raising cash in anticipation that I'm going to be able to buy these things at a lower discounted price. There are 4 phases of the market. There are 4 phases for sectors. There are 4 phases for individual stocks. 90% of stocks are going to follow the overall market environment. So we have the mark up phase. That's when the stocks are in a nice bull run and heading higher. Then we have a distribution phase when you get that topping out. The markets really don't go anywhere. A lot of choppy action. And there's distribution. Once the distribution phase is done, we head into the markdown phase, where markets and stocks are selling off. Now, what you'll notice is that in a markup phase, it's often a stair step. We're stair-stepping our way higher. When we start the market down phase, we take the elevator down. It's much more significant and it's much scarier than the market up phase. Then we go into the accumulation phase, which is when the value players come in. During the market up phase, that's when you have your momentum players. During the accumulation phase, you have your value players. The stocks that have been beaten up so badly that the guys that are value seekers can't resist but to start building a position. So identifying what phase a stock, a market, or a sector is in is going to help you identify whether or not you should take a trade. So let's start out with the IWM. This is a daily chart, and you can see clearly that we are in a short-term downtrend. And remember what I said, when we get into the downtrend, the markdown phase, we take the elevator down. You can see here that we started topping out. We were in a consolidation phase and finally gave it up. But let's back out to the weekly. It's important to understand that no matter what time frame you trade in, whether you're a day trader or you're a swing trader or an investor, the longer the time frame, the more dominant the trend. So what we can see from the daily is that the IWM is in a clear downtrend. But if we back out to the weekly, we can see that up until this week, actually, was it this week? No. Up until a few weeks ago, we were in a clear, dominating upward trend. Very clear. We've tested and we're unable to break through this trend line. We have just recently taken this trend line out. Now that is very concerning if you're looking at buying small cap stocks, because we've broken a long-term trend. And a new long-term trend could be developing. We could be in a prolonged markdown phase. We haven't seen signs yet of the accumulation phase starting. So we have a broken long-term trend. We can do this in markets, in specific indexes. This is the NASDAQ. Let's take a look at the NASDAQ. Clear, long-term, dominating trend to the upside. Unlike the IWM, we have not broken this long-term downtrend yet. Now, we have broken what happens when we're in a long-term trend is sometimes you start to accelerate from the original trend. You start to ramp up and pull away from the trend line. So as you look at this, we came down, we tested, and eventually we pierced through. We reclaimed that trend line. And keep in mind, each candle here represents a week. We pierced through, we came down, we tested this trend line here, bounced off of it, reclaimed this trend line, broke back down. We were unable to make a higher high, and we started making lower highs. Eventually breaking through this trend line, piercing this one, reclaiming it, and now we've broken through again. On our way to approaching this gradual trend line here. We're going to go into support and resistance, and there are a lot of different indicators that people use to identify support and resistance. We're going to go through that in the next segment, but for now we just want to recognize the dominant trend. So we have a dominant trend in the NASDAQ, which is still to the upside, that has not been broken. Let's take a look at the S&P 500. Clearly, even without any technical skills whatsoever, someone could look at this chart and say we are in a long-term uptrend. Currently in a short-term uptrend or short-term downtrend that's about to test the long-term trend. So in this market climate, it's significantly more difficult to take long biased trades. This is more of a market for short sellers or bearish ETFs. If you don't want to take shorts, you don't have to take shorts. You can just buy bearish ETFs. So that is the overall indexes, but then there's also ETFs, which have become very popular for trading because there's a tremendous amount of liquidity. You have leveraged ETFs, which are 3 times. You can get 2 times and 3 times. And if you're interested in ETFs, remember, we talked about Investopedia. Just go to Investopedia and punch in ETFs, and it'll tell you the most popular ETFs for retail, for aerospace, for the industrial sector, real estate, okay, commodities. There are ETFs for everything, and they're very liquid. So that has become a very popular day trading tool, as well as a investment tool. You're not stuck into one specific stock. They collectively have a group of stocks or a group of companies that make up the ETF. So why would I want to look at a specific sector? Well, if I'm looking at taking an investment in a bank, if I want to start putting it in my investment portfolio, I want to get a clear picture of what is happening in the financial sector. Now, here we can see on a long-term chart, weekly chart, that we are in a dominant uptrend. But if we close in here, we can see that that dominant uptrend is being tested. And if we break below this long-term dominant trend line and start a new trend to the downside, there could be significant amount of pain ahead for the financial sector. And that's going to include banks. So that's going to make me a little gun shy when it comes to looking to take a specific or a long-term investment in a bank. However, if I go to the daily, I see that I've got a candle, and we'll go into this in greater detail later in the program, but I can see that I have a candle that has pierced out of the lower Bollinger Band. Oh, actually, let me go to the daily. Completely out of the lower Bollinger Band. We're getting a bit of a little bounce here. Stochastics are oversold. We're crossing to the upside. We could get a short-term snapback within the financials. So that becomes attractive to me for a potential day trade, or even a short 2, 3, 4 day swing in the financials in a bank. So it's extremely important to know what's going on in a specific sector. If you're looking at taking a stock, let's say in the semiconductor sector, not only do you want to recognize what trend that stock is in, you want to recognize what trend the sector is in. So let's go to the SMH. Here we are on the daily. We are clearly in a short-term downtrend. And trend lines act as resistance. We're in a short-term downtrend in the SMH. Let's back it out to the weekly. And we can see that we're in a pretty clearly defined long-term dominant trend to the upside. But we again are in a position where we are testing that trend line. So that's going to make me a bit more cautious about taking a trade in the semiconductor sector. Now I go through, let's take a look at one other thing. Let's look at commodities. Let's look at gold. Now here's an example where gold was in a long-term uptrend and broke through. Let me clear up some of this stuff actually. Let me clear up all these. So we can see that from 2007 basically, Actually, we could start in 2009. We were in a nice uptrend in gold. Okay? And that basically started in 2008, end of 2007. That is when we had the financial collapse and gold went on a incredible run. It really ramped up. So if you look at it, this was the more gradual uptrend. Then it really accelerated and ramped higher until we eventually started breaking through. You could draw another one of these lines right here, right? And you can see how this trend line acted as support. Acted as support, eventually broke through, tried to reclaim it, and failed. That became resistance. And the same thing here. It came down, almost touched this trend line here. Actually, we can tighten that up a little bit. Bounced up here, pulled back, eventually broke through, and now it's coming down, and it has successfully tested this long-term trend line. Now we broke through, and recently, with the market weakness, we've seen gold reclaim this long-term trend line. So this is for every sector. Let's take a look at the IBB. Which is the biotech index. More of a gradual slope from 2009. Very gradual. And then we started to get some acceleration. Let me go to a cleaner chart here. Back it up to the weekly. Coming up to this trend line here, we had the acceleration or ramp up. Eventually, we broke down. It's tried to act as support. We broke through. Now we're coming down to this trend line here. Also, a 200-day moving average. If we lose this trend line, we could come all the way back down here and still remain in a dominant long-term uptrend. It's important for you to look at things on multiple time frames, not just the daily. Take a step back. If you're a day trader, you don't want to just be constantly looking at the 1 minute or the 5 minute chart. You want to look at the 1 minute, the 5 minute, and maybe the 15 minute. Or possibly you want to look at the 5 minute if you're comfortable. I personally like to day trade within the 5 minute. The 1 minute's too bouncy for me. You want to look at the 5 minute, a 30 minute, and the daily to help you define trend lines and potential areas of support and resistance, which we're going to go into further in the next segment. The importance of recognizing what's happening in the overall market or what phase we are currently in is extremely important. And it's something that you should start to familiarize yourself with on a weekly basis. We're going to end this segment here. I'll be back with the next segment where we can talk about support and resistance.